On Business Incorporated today, IATA approves a resolution for global air transport industry to achieve net zero carbon emissions by 2050. AFDB to equip 40 million African farmers with modern and climate-resilient technologies by 2026. Zimbabwe Stock Exchange launches online mobile trading app. Hello and welcome to the program. I'm Chimeze Obi Iwago. First, the markets numbers, and we'll begin with numbers from Africa, where major stock markets we track were mostly positive at intraday. Nigeria's NGX rose higher by 0.20%, while South Africa's JSE index traded higher at 0.11%. On the other side, Egypt's EGX 30 fell by 0.12%. Meanwhile, Kenya's main index closed positive in Monday's trading session, up by 0.38%. In the meantime, Zimbabwe's stock exchange has launched an online trading application which will enable retail investors a smart way to manage their investments in a highly informative way. In an update, ZSE Chief Executive Officer Justin Goni said the application's availability is effective from this week. The ZSE Direct mobile app is currently available on Google Play Store for Android users, with plans to make it available on Apple Store in the shortest possible time. The commodities market has also added new features to ZSE Direct platform launched 1 year ago that will allow broad information access. The platform has evolved over time, introducing key features that have made the ZSE into a friendly and yet sophisticated market, especially for retail investors. And in the Middle East, mixed sentiments were seen at intraday. Both Abu Dhabi and Dubai's indices dropped by 0.13% and 1.02% each. In the meantime, Saudi Arabia and the Qatari index posted gains at intraday, rising 0.79% and 0.08% each. And in Europe, stocks inched into positive territory in the morning, with regional investors brushing off losses on Wall Street on Monday. Let's bring in Chelsea now for more. Hello, Chelsea. Good afternoon. Well, markets seem to be focused today on the decision from the OPEC Plus not to increase production despite rising crude prices. Is that decision impacting the equities market as well today, as we saw stocks rising in early trade?
It hasn't had as much of an impact here on the European trading, but it certainly did have a bigger impact in Asian stocks as well as U.S. stocks. Here in Frankfurt, traders seem to be brushing this off, but even so, it is a major concern that OPEC is not going to be boosting production. We've seen oil prices really spike on that news. We saw the global benchmark rise above $80 a barrel. U.S. crude prices at a 7-year high. So oil prices are definitely on the rise, and as we've been discussing, there's right now already an energy crisis here in Europe. We're seeing very, very drastic increases in natural gas prices. There's a big shortage of natural gas here in Europe. So now that we also could be facing a shortage of oil and gasoline, that's going to add more pain onto the situation. Many businesses will likely face higher oil costs for transportation. Many people will face higher prices at the pump as well. A lot of power producers here had been switching to oil to generate electricity because of these high natural gas prices. So all of this feeds fears over inflation, which is already at a 13-year high here in Europe. It likely will get higher if we continue to see oil prices gain.
Now, economic activity slowed across the Eurozone in September, according to newly released data. What is driving the deceleration?
Well, one of the big factors in this slowdown in growth here is, of course, the supply chain issues, not just energy sources, as we've discussed, but also just a broad range of different commodities, things like steel, lumber, as well as semiconductors have all been in very short supply this year. So that's really been difficult for manufacturers, particularly here in the auto sector. And at this point, there's really not a lot of hope on the horizon that could be abating anytime soon. We've seen several major automakers here in Germany, for example, like Volkswagen, Daimler, Opel, start to cut back production even further because they just don't have enough semiconductors to keep going. So that's been a big drag on the manufacturing side of the economy. But what's interesting about the report we saw today is that it looks like this is starting to spill over into the other side of the economy, the services side, which is more things like retail or restaurants or hospitality, as well as transportation. All of these companies are starting to face issues with rising prices and inflation. It looks like people are starting to actually cut back spending because of the inflation pressures we're seeing. So all of this points to the fact that growth here in Europe likely has peaked for the time being.
And EU leaders are meeting today to discuss the bloc's relationship with its two biggest trade partners, the US and China. What's on the agenda?
Well, this discussion is being called Europe's place in the world, the EU's place in the world, and that's really what it's going to focus on, what role Europe is playing in the geopolitical sphere. And it's a bit of a difficult time for Europe. On the one hand, relations with China have really worsened over the past year or so. Europe is a major trading partner with China. A lot of European companies are very dependent on the Chinese market, but we've seen Europe take a bit of a harder line approach to China, particularly with the situation regarding its Uyghur minority Muslim population. The EU has sanctioned China for abuses against that population, and China has hit back. And so we've seen that really boil over onto the economy with sanctions and canceled trade deals. So Europe wants to think about how its relationship is going to look like with China going forward. It wants to be less dependent on China, but that's going to take a lot of work. So they're going to discuss that as well. The relationship with the U.S. has just been dealt a major blow after Australia canceled a submarine contract with France in favor of the United States. So French President Emmanuel Macron is expected to say today that the EU can no longer count on the U.S. as a major trading partner. So this really highlights the position that the EU is in. It doesn't trust its major trading partners anymore. It wants to be more independent, but the EU is still very dependent on these economies. So it needs to think of how it could potentially become a more autonomous, a stronger bloc, both economically and geopolitically.
Thanks, Chelsea, for updating us on those. I hope to see you tomorrow. Enjoy the rest of the day. And in the UK, we are looking at a number of data, UK car sales, as well as the services PMI. Let's bring in Juliana now for details. Hello, Juliana. Good afternoon. Well, data in this morning shows the UK car market has recorded its weakest September since 1998. That's despite record sales of battery-powered electric cars. Supply issues caused by semiconductor shortages is mainly to be blamed. Unfortunately, some analysts say supply chain problems are unlikely to ease before Christmas. How worrisome is this situation?
Good afternoon, Chimese. Really worrisome. In fact, one industry insider said the data released this morning is desperately disappointing, particularly because last year, of course, car manufacturers had a really torrid year. They were dealing with lots of lockdowns. People weren't going out, so people weren't buying new cars. So they had hoped that last month's figure would have been enough to clean up from last year's losses. But alas, that's not been the case. They were down 34%. And as you said, this is the lowest September month in 2 decades. And that's because September is a really lucrative time for car makers. This is the time of the year when they release their new plates. So if you had enough money, you would have been buying last month a new flashy car that had a 23 plate on it. But that hasn't been the case. And as you said, it doesn't appear as if the shortage of semiconductor chips will be abating anytime soon. The Society of Manufacturers and Traders Society, they believe it could take until next year for factories that are dotted up and down Asia to start pumping out these chips, which would mean that car production can be up and running again. On the flip side, as you were saying, electric-powered vehicles are doing very, very well, especially at a time when people are struggling to get petrol. I don't know if you've seen those memes, Chimeze, on Twitter and social media showing electric car vehicle drivers pretty happy because, of course, they can zoom past petrol stations here in the UK. And, of course, this is a part of a much wider strategy of Boris Johnson's government to ban new sales of petrol and diesel vehicles by 2023. So at the moment, electric vehicles in the UK make up to 15% of new car sales, which is definitely on target.
Well, I guess a lot of people would find a way to go for the EVs. Anyway, we also get new health checks on UK services PMI for September. What does it say?
Yeah, it's not great, but better than last month. The services sector's come in at 55.4. In August, it was 55. So a marginal increase, but still, last month was at a 6-month low. And again, supply chain issues continue to hamper Britain's economic recovery from the pandemic. Lots of people that conducted or took part in the survey said that they're having struggles with labour shortages of commodities. Lots of different issues are making it difficult for businesses to be prosperous. Also, as well, the fact that there are shortages, this is pushing up those inflation figures, which is really starting to show. So there are issues, not enough to keep the benchmark down. Of course, 50 is that all-important benchmark. Anything above 50 shows growth. But of course, if we are going to be getting ourselves out of that post-pandemic slump, we do need these PMI services figures to be much higher.
And Facebook, Instagram, and WhatsApp working again after a global outage took down platforms yesterday. How is the market trailing these developments as well as the data out this morning?
Well, luckily for the FTSE All-Share in the square mile, it's not so tech-heavy. So even though there was a mass sell-off on Wall Street and the Nasdaq last night, it didn't affect the FTSE. In fact, it's been trading in positive territory all day. Even the services PMI data didn't dampen any sentiment, but that's obviously because of Brent crude. A barrel of Brent crude is trading up. So the FTSE All-Share is up 0.63%. At intraday, the FTSE 100 is also up by 0.60%. And the FTSE 250 is up by 0.51%. In the currencies market, the British pound is up on the US dollar by 0.22%, up on the euro by 0.37%, and also up on the Japanese yen by 0.51% at intraday, Jimmy.
All right, Juliana. Well, tomorrow is another day. Enjoy the rest of the day.
You too, thank you.
And shares in Asia Pacific largely fell in Tuesday trade following overnight losses on Wall Street, with a tech-heavy Nasdaq Composite falling more than 2%. In Japan, the Nikkei 225 dropped 2.52% as shares of fast retailing fell 6.95%. The Topix Index also declined 1.64%. South Korea's Kospi shared 1.88%. The Hang Seng Index in Hong Kong backed the overall trend regionally, trading flat. Shares in Australia also slipped, with the S&P ASX 200 down 0.41%. The Reserve Bank of Australia on Tuesday announced its decision to leave interest rates unchanged. MSCI's broadest index of Asia-Pacific shares outside Japan traded 0.54% lower. Markets in mainland China remain closed on Tuesday for the holidays. And stock futures gained as the major averages appeared set to rebound from Monday's tech-focused sell-off. Futures on the Dow Jones Industrial Average gained 151 points. S&P 500 futures rose 0.44%, while Nasdaq 100 futures added 0.34%. Well, tech has been the worst performing sector of the last month as a jump in yields caused investors to rotate out of the highly valued shares since rising rates can make their future profits look less attractive. After Monday's sell-off, the Nasdaq Composite is now 7.5% off from its record, while the S&P 500 is 5.4% lower. In Washington, lawmakers are still trying to agree to raise or suspend the U.S. borrowing limit and avert a dangerous first-ever default on the national debt. We take a break now, and when we come back, commodities market update is next, as well as other developments on the African continent. Just stay with us. On commodities market update today, we're looking at cocoa. West Africa produces approximately 66% of the world's cocoa. Ivory Coast is the world's largest producer with 1.6 million tons per annum. Recently, Ghana and Ivory Coast set up a COPEC to control price, output, and child labor, also ostensibly to establish themselves as price leaders. Yesterday, Ivory Coast set a price for the 2021-2022 season 18% lower than the current price of $1,836 per ton. At the same time, when global commodities index soared to an all-time high of 1.1%. For a better understanding of the recent development in the cocoa market, let's have Mayowa Ige, research analyst with Financial Derivatives Company, join us now. Good afternoon, Mayowa. Good to see you.
Good afternoon, Chimeze. Good to see you too.
So what is your reading of the global cocoa market based on this recent move by Ivory Coast? Is there a contradiction here?
So we know that cocoa is primarily used in the production of chocolate and beverages, right? And during the pandemic, we saw a huge decline in the demand for out-of-home consumption chocolate, and also a strong decline in sectors such as the hospitality sector and entertainment sector, where there are huge consumers of chocolate, right? And so this led to an increase in supply of cocoa over the past season. And we saw an increase of about 90% compared to the season before that. And during the same period of the pandemic, we saw that Ivory Coast and Ghana came together to form a committee to control the price of cocoa. But what happened when they did this was that we saw large corporations actually started avoiding buying cocoa from this region, and they started bargaining down the overall prices of cocoa globally. And I think that right now Ivory Coast has seen that, and they're learning their lesson from the past year, and so they're trying to establish themselves as price leaders and trying to set a floor price of cocoa globally. Looking at the global scale, the global commodities market, like you mentioned, we expect that the global economy is going to increase, and we will see an increase in economic activities by about 4%. And this, we expect to also see that. We expect to see the impact of that on the commodity prices. We see commodity prices also increase over the period, and we think that cocoa would also not be exempted from this. As global activities pick up, we will see that the demand for cocoa will rise to meet the supply or already existing supply of cocoa, and possibly even surpass the supply of cocoa that we have currently. And so we'll probably see an increase in prices of cocoa over the next 1 year.
So while cocoa production is increasing globally, Nigeria's already low cocoa production declined further by 18% over the past year. What is responsible for the disparity in production? And do you think this is an issue of export smuggling?
So Nigeria, despite our very large land space, we actually produce a lower yield per hectare of cocoa compared to the global producers like Ivory Coast and Ghana. And this is as a result of a number of reasons. Some of the reasons include, one, we have exchange rate uncompetitiveness. And the reason why I say that is because currently we actually export 90% of cocoa we produce in Nigeria and only process about 10%. And then you have farmers, the farmers use the IE exchange, they are forced to use the IE window exchange rate, which is not very competitive, especially when you compare to the exchange rate at the parallel market. right? And so this doesn't encourage a lot of production. And number two, we have smuggling. And if this smuggling is actually tied to the exchange rate on competitiveness, if I can put my cocoa on a barge to, say, Ghana and get it and sell at a premium price, that is more, farmers would be more interested in doing that than actually keeping the cocoa here and producing and exporting here. And then number three, we have the issue of poor weather condition. Just this season, Cross River, our second largest producer of cocoa, lost about 30% of their harvest due to shortage in rainfall. Then number four, we have the issue of urbanization. Cocoa is labor intensive, right? And so most of the labor that we had in rural areas in times past, most of them have moved to the urban centers, creating a gap in manpower. And lastly, we have the issue of poor farming techniques, which have greatly affected our production of cocoa in Nigeria. This has affected our production of cocoa in Nigeria, yes.
Now, do you think that the decline in global cocoa prices will actually discourage Nigerian cocoa farmers from production?